అయింది. ఒక్క నిమిషం. Namaste to all. As we are discussing about the ratio analysis chapter, in the last class we discussed about the profitability ratios. I give quick revision of it and some tip to remember the ratio. In case of a return on investment or return on capital employed, a return on equity or return on shareholders fund. In all these cases, net profit or operating profit will be your numerator, and if it is return on investment we will take total asset. It is return on capital employed, in denominator we will take capital employed. Okay, if it is return on shareholders fund, in denominator we will take shareholders fund. Numerator will be always net profit or operating profit, depends upon the situation given in the information. For the other ratios like net profit ratio, operating profit ratio, gross profit ratio, operating ratio, cost of goods sold ratio, or other expense ratio, your denominator will be net sales and numerator will change. If it is net profit ratio, net profit. If it is gross profit ratio, gross profit will be your numerator. In case of operating ratio, total expenses we will take. In case of operating profit ratio, operating profit we will take as numerator. And cost of goods sold, material consumed, or labor cost, in all the other ratios, here numerator will change and denominator will be the same. So this is how we should remember the formula. Tip for the remembering the formula. Next we discussed about the liquidity ratios. Liquidity ratios are solvency ratios. Short term solvency, we are having three things. One, current ratio, another liquid or quick asset ratio or acid test ratio we call, and next super quick assets ratio or absolute liquid ratio. In these cases, denominator will be current liabilities always and numerator will change. In case of current ratio or working capital ratio, current assets. In case of liquid ratio or quick ratio, quick assets or liquid assets. And super quick ratio, super quick assets divided by current liabilities. The denominator is always current liabilities, numerator will change. Current assets includes cash, bank, marketable securities, short-term investments, sundry debtors, bills receivable, inventories, prepaid you can call it inventory or stock, both one and the same. Prepaid expenses, these all comes under current assets. What is quick assets? Quick assets is equals to current assets minus stock and prepaid expenses. Okay. Super quick assets is equals to quick assets minus sundry debtors, bills receivable. This is how we need to remember the things. Let us go to the our next ratio, that is turnover ratios or activity ratios or performance ratios. So turnover ratios or activity ratios, there are many turnover ratios, but it is easy to remember these if we have some logic behind it. Okay, if we understand the logic, we can easily remember the ratio. See there, capital turnover ratio. Turnover means here sales. we will take for the turnover ratios gross profit, how to cost of goods sold, how to get cost of goods sold. If cost of goods sold is equals to sales minus gross profit. If gross profit is not there, then to know gross profit, cost of goods sold, mm, we will use another formula like opening stock plus net purchases plus wages manufacturing expenses minus closing stock. That is the other method to know cost of goods sold. If in the case we cannot have these information like opening stock, net purchases, wages, closing stock, all these information, then we will see is gross profit is given or can we calculate gross profit from the given information. If in the given information, if we can find out gross profit, then we use cost of goods sold, otherwise we will use sales in all turnover ratios generally. So it will known in the number of times, how many days it will require, how many times it is, that is what here it means. So cost of goods sold are sales divided by capital employed, capital turnover ratio. Capital employed is equals to, as we discussed earlier, share capital, equity plus preference shares, reserves and surplus, long term medium term loans minus fictitious assets if any. Why it is used? To show the efficiency of capital employed in the business. The higher the capital turnover ratio, the better it will be for the profits. So this is how capital turnover ratio will be there. Our next ratio is total assets turnover ratio. Total assets turnover ratio is equals to cost of goods sold divided by or sales divided by total assets. As I said, cost of goods sold will be calculated sales minus GP. If cost of goods sold is not available, we use sales. In denominator, total assets we will take. Total assets includes all assets excluding fictitious assets. Why it will be used? To know the utilization of total assets in the business. How much assets have been, how properly assets have been utilized for the business operations, that is known. The higher the total assets turnover ratio indicates good capacity utilization, whereas low total assets results idle capacity, waste of the assets. Next one is fixed assets turnover ratio. What is fixed? Here we only consider fixed assets, not total assets. Cost of goods sold divided or sales divided by net fixed assets. Net fixed assets means gross fixed assets minus depreciation we will consider. If depreciation is not given, you take fixed assets total. So same way, if cost of goods sold is not available, then only we go for sales. If depreciation is not there, then we use gross fixed asset. It indicates how and to what extent fixed assets contribute to sales. सेल्स के लिए फिक्स्ड असेट्स का कितना कंट्रीब्यूशन है. हायर दिस फिक्स्ड असेट्स टर्नओवर रेशियो, बेटर इज द परफॉर्मेंस ऑफ द कंपनी. ओके, नेक्स्ट वर्किंग कैपिटल टर्नओवर रेशियो. Working capital turnover ratio means here we take working capital in the denominator. What is working capital? Current assets minus current liabilities will be known as so working capital is equals to current assets minus current liabilities. Current cost of goods sold divided by working capital. If cost of goods sold is not available, we will consider for sales instead of cost of goods sold. Okay, this is the formula for the working capital. Next, what is the use? How to know the number of times working capital is turnover during the period? High working capital turnover ratio reveals that working capital funds are properly employed to generate the more sales for the business. This is what we will interpret it. Next, next one is inventory turnover ratio. In inventory turnover, cost of goods sold divided by average stock we will take. How to know average stock? Average stock is equals to opening stock plus closing stock divided by 2. Okay, if cost of goods sold is not available, then we will consider sales for the same purpose. So till now we have studied 5 turnover ratios. See, capital turnover ratio, denominator is capital employed. Total assets turnover ratio, total assets are in the denominator. Fixed assets turnover ratio, net fixed assets are in the denominator. Working capital turnover ratio, working capital is in the denominator. So how to remember the formula means the question itself is saying about what will be your formula. Capital turnover ratio, capital employed will be in the denominator and numerator will be sales. Similarly, total assets turnover ratio, total assets will be in denominator and sales will be, or cost of goods sold will be in numerator. Fixed assets, net fixed assets will be in denominator. Working capital turnover ratio, working capital will be in denominator. And inventory turnover ratio, here is some change till now. What is that? We need to take average stock in the denominator. Turnover, here inventory means stock. So average stock, how you will get? Opening plus closing by 2. Opening stock plus closing stock divided by 2. To indicate the efficiency of use of investment in the stock, and high inventory turnover ratio is better since it means good are sold faster. आप जल्दी जल्दी सेल कर रहे हैं, आपके स्टॉक को किस में कन्वर्ट कर रहे हैं? सेल में कन्वर्ट कर रहे हैं बोल के पता चलेगा. हाँ, डोंट वरी, देर आर some more turnover ratios, but these are easy turnover ratios. Next we are going to discuss little bit critical turnover ratios. Next one is, just now we have discussed inventory turnover ratio. Now we are going to see inventory turnover period. How many days it will take? How many times it is we have studied? How many days it will require to convert stock into sale? That is inventory turnover period. If your inventory turnover ratio is more than 12, I say, please remember, if your inventory turnover ratio is more than 12, if inventory turnover ratio is more than 12, लिखना नहीं आ रहा भाई, remember it, then we need to take 365 divided by inventory turnover ratio. Then you will get details in days. If it is less than 12, that is 10, 9 or 6 like that, then 12 divided by inventory turnover ratio, then you will get in months, that is inventory turnover holding period. Next one is interpretation and use. To find out the days or months stock are held before they are sold. How many days we are keeping the stock in our hands before it is to be sold. The lower the inventory holding period, it is better. कितने कम दिनों में आप सेल कर रहे हैं वो बेटर हो जाएगा. So that is why it should be lower. Next, debtors turnover ratio. Please remember here also net credit sales. What we need to take? Net credit sales in the numerator divided by average accounts receivable. Accounts receivable here includes sundry debtors and bills receivable. So accounts receivable means sundry debtors and bills receivable, but we need to take average accounts receivable, that is opening accounts receivable plus closing accounts receivable by 2. You will get average. So with that we need to calculate debtors turnover ratio. So net credit sales, why we are taking credit sales? Debtors arises in case of credit sale. How to get credit sales? Total sales minus cash sales, you will get credit sales. Use to show the efficiency with which debtors are converted into cash. How many days our debtors are converted into cash, कितने दिनों में रियलाइज हो रहे वो मालूम होना है. Higher debtors turnover ratio better since it indicates prompt collection from the debtors. जितना जल्दी हो सके उतना बेटर होगा. नेक्स्ट, debtors collection period. Debtors collection period. Debtors collection period similar to 12 months or 365 divided by debtors turnover ratio. How to get debtors turnover ratio? Array debtors turnover ratio will be known in the earlier formula, net credit sales divided by average accounts receivable. So that will be used in the next formula. Next, creditors turnover ratio, net credit purchases divided by average accounts payable. How to get net credit purchases? Total purchases minus credit purchases, you will get net credit purchases. Accounts payable includes sundry creditors plus bills payable. Opening accounts payable plus closing accounts payable divided by 2, you will get average accounts payable. So this is how it will be done. To indicate the speed with payments are made to the creditors. What is the use of this ratio? Means to know how frequently we are paying our creditors. High Creditors turnover ratio means quick payment to which has to favorable effect to the company. Credit rating, a low turnover creditors turnover ratio delays payments which adversely affects the credit rating of the company. Next, creditors payment period. How to know creditors payment period? 12 or 365 days divided by 12 months or 365 days divided by credit turnover ratio. If it is more than, I'm saying, if creditors turnover ratio is more than 12, then you take 12 divided by, sorry, if it is more than 12, you take 365 divided by CTR. If creditors turnover ratio is less than 12, you take that 12 divided by creditors turnover ratio. To find out the days or months it takes to pay the creditors. These are the various टर्नओवर रेशियोस. आज के लिए इतना ही, बहुत ज़्यादा हो गया, बट टर्नओवर रेशियोस आर वेरी इंपॉर्टेंट, सो रिमेंबर दिस, राइट इट इन योर नोट्स. एंड एज आई से एवरी टाइम, सीखना बंद तो जीतना बंद, तो सीखते रहो जीतने के लिए. एंड बैटरी इज ऑल्सो लो. स्टे होम, बी सेफ, कोरोना से दूर रहना. बाय, टेक केयर, जय हिंद.